Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Rally on after a couple days rest. Tech is off and running again, literally carrying stocks through this first quarter. So is that run really sustainable or soon to reverse? We debate that key question with the investment committee. Joining me for the hour today right here at Post 9, Joe Terranova, Jason Snipe, Jenny Harrington, and Steve Weiss. I'll show you the markets, what we are doing. We're green across the board, as you probably know by now. NASDAQ is the outperformer today, yet again, 1.75%. Joe, I turn to you. So it was a brief pause, rest for a couple days. This amazing run continues for tech. Best month to date, best year to date in terms of sectors. Where does it go from here?
I think what was good is while we had that little pause for technology, the other sectors actually came forward and picked up the performance. So it was energy, it was financials, it was healthcare. It was the areas of the market that have underperformed so far year to date. We had this conversation on Monday. I told you about my conversation with Larry Altman. We both felt as though that the market was going to be able to catch its breath. I think that's exactly what's happening right now. It's one of the reasons why last Friday I bought JP Morgan, I bought IBB. I think there's further upside potential in the near term for the market heading into Friday's PCE inflation figure. And really, the $5.1 trillion that we learned last week is sitting in money market funds. I think right now, the overweight positioning and the most risky positioning is sitting in so much cash. Because you can't tell me that everyone's going to perfectly time and take the reinvestment risk so effectively out of the money market funds back into risk assets.
So we got a couple days left, Jason, the quarter, and it's been really tech top heavy.
Yeah.
Right. Absolutely. Pisani had some great data earlier today. S&P's up 3.4% this year. The 7 mega cap tech stocks are responsible for a 5% gain in the S&P, meaning the rest of the 493 are underperforming. So if you take the, let's call it the 4 mega caps, okay?
Yep.
Apple up 23% in the quarter, Microsoft 16.5%, Alphabet 15%, Amazon 19%, and then the so-called second tier, NVIDIA 84%, Meta 70%, Tesla 56%. That is just in the quarter. Is that top heavy okay? Because we've been here before, where those types of stocks have carried the whole load for the market.
Right.
Is it good or bad right now, though?
I think it's tough. I think, a couple things. I think, one, a lot of folks were offsides at the beginning of this year.
That's for sure.
From a cyclical perspective, folks were looking at value-oriented sectors, financials, healthcare, energy as the places to be. And obviously, tech has been the outperformer. My concern is, if I look at the NASDAQ 100 as an example, the NASDAQ 100 was trading at 20 times at the end of December. It's now at 24 times. We have a Fed that's still engaged. We're closer to the end than we are the beginning. I'm also concerned about loan demand. And Joe just mentioned it. I mean, the optionality from a cash perspective, cash management perspective. You could look at money market funds that are paying 4 to 5%. You could look at a 6-month Treasury that's paying close to 4.6%. So with the Fed that's engaged and longer duration assets potentially being under pressure in the second half of this year, and inflation still relatively high. So I think that's my concern.
Jenny, we asked a question yesterday right at the top of the show. Do you continue to buy into the tech run or do you fade it? It leads me right to you. What you guys have done in your growth portfolio today, okay? You trim Meta. I mentioned what Meta's done in the quarter, up 70%. It's been unbelievable. Palo Alto is up 30-something percent, 35, 36% in the quarter as well. You guys trim it.
Right.
So is that a statement about, taking some risk off the table in an area that's gotten a little too ahead of itself?
100%. And I think that's good portfolio management. So we look at these companies and we say, look, they still have great earnings growth ahead. They have strong free cash flow yields. They're not, in Meta's case, now it's trading at a multiple, at a premium multiple to the market, where they historically for last year has traded at a discount. So we could say they've really gotten their love, right? A year ago, 6 months ago, they were underappreciated. Now they're well appreciated. So we took them both from about 3.5% positions in the growth portfolio to 2.5%. Free up that cash and repurpose it elsewhere, which I think is really, if there is one big theme that we talk about today, I think that's going to be where we should go.
Weiss, according to Jefferies, the so-called smart money has been buying tech for the last few months. Hedge funds leaned more towards secular growth in January, according to the data from Jefferies. Much of the increase in their overall overweight was focused on tech and comm services. Smart money, smart bets. What do we think?
Yeah, I think if you take a look at their business models historically, their balance sheets are in great shape, so they're not going to have that stress.